This is Real Estate This Week with Stephen Gasque. 17 years on air and online, helping you succeed in buying, selling, and investing in property. The best real estate strategies out there, just for you.
Welcome to Real Estate This Week. Hi again, I'm Stephen Gasque, and I'm so glad you're here as we look at getting the money to buy the house. Mortgages in the spring market. Are you all ready to apply, to get qualified, and to buy that house? Let's talk about it with a mortgage expert. Joining us now is Sol Skolnick, known as Professor Home Loan, a mortgage professional with United Mortgage Corp., a mortgage-only bank. Sol is the author of the book Home Loans Made Simple. Sol, welcome to Real Estate This Week.
Good morning and thank you.
I am so glad you're here. So talking about mortgages in the spring market, my first question is that you center on readiness, being all prepared and ready to go. Tell us about that, Sol.
Well, the very first thing that one needs to know how to do and what to do is what can you afford? What will a bank tell you that they will lend you? And then, more importantly, what can you afford to pay each month after that? Because the important point is that when a bank qualifies you for a pre-approval or ultimately for your loan, they're doing it based on the principal, interest, taxes, and insurance only. They're not counting the fact that you're going to pay electric, you're going to pay all kinds of other utilities, you're going to pay cable, you're going to pay website. So those are things that I remind people right away. Don't look at the number we're giving you. Make believe you're writing the check and tell me if you're comfortable.
Well, a lot of people think that the mortgage company is protecting them by looking at the ratios between their debt and their income. But is that not the case?
The daily expenses are not considered debt. So if you have a car loan, if you have a student loan, those are considered debt. Credit card is debt, but electric, telephone, anything else to run the house, getting the lawn done, if garbage is not part of what your village gives you, all of those things are costs that you need to figure out separately.
Oh, that's so interesting. And you're really making a wonderful point, Sol, which is many people get into a house and they own it and then they create a budget. But your idea is create that budget before you even buy the house. That's great advice.
Thank you very much. No, absolutely. You need to know what it's going to cost because the biggest difference between renting or living with your parents, as many people are now doing into their late 30s, and owning is it's all about you and what you can afford. And we know the taxes will always go up. We know utilities are going to go up. So when people tell you it's a fixed mortgage, yes, your monthly payment for the principal and interest may be fixed, but that's it.
And another thing that you mentioned is there's a difference between what you can afford and what you are comfortable spending. And as you put it, those may not be the same thing.
Right. Again, I always want to let people know that the bank is looking at it a certain way. And then you have to understand, what are you comfortable spending each month? What's going to be okay for you? What will allow you to do the other things that you need and want to do with your life? Whether it's sending kids to summer camp, going out once a week for dinner, or for other expenses that we don't think of as, routine day-to-day things. Because once you own the house, yes, you can potentially are building equity, but the expense doesn't go away.
Excellent advice, Sol.
Thank you.
And now, once you get a range from your mortgage originator about how much house you can afford, that's a huge help to most buyers because many have no idea how much house they can afford.
No,
so tell
course.
us about that price range and how that helps people.
Well, what it lets them do is ask themselves what they need. First of all, how many bedrooms do they need, bathrooms? Do they need a backyard? Do they need access to railroads or trains or other kinds of public transportation? What do they need in the community? Then they look at the house itself and say, okay, how many bedrooms, how many bathrooms? What will I be comfortable doing every day to run my house? So that becomes part of it.
And part of the shopping process, when you're looking for a house, it really helps to have that range because, many people will see an open house sign and go in and the house will be really $300,000 or $400,000 more than they can afford, but they fall in love with it only to find out there's no way. But knowing that number ahead of time avoids that heartache.
Absolutely. And again, I don't know in your market, but certainly here in the New York Metro, Connecticut area, house prices have obviously gone up, but the availability of housing stock has not increased the way people might have expected that it would. So you get a lot of people coming in over asking. You get people who are trying to compete with cash offers. It becomes very competitive. And for people, especially doing it the first time, that's a lot of extra stress over and above figuring out whether you've picked the right house.
And so, Sol, here's a big question for you. Everybody who's looking for a house has heard about the pre-approval letter. But when should you get that from your mortgage professional? Should you get that as soon as you find a house and you want to buy that house? Or should you get it much earlier than that?
Well, you should be getting some kind of a pre-approval when you're doing the initial discussion with your mortgage originator. Now, the pre-approval letter tells you that a lender has estimated that you are qualified for a certain amount of money. The problem with pre-approval letters is it always has a line in it that said, this is not a commitment to lend. So what that means is that if any of the information you've given them is not 100% correct, or any of it changes between now and then, that pre-approval is not going to lend to turn into a commitment. What I recommend is you work with a lender that can give you what's called a TBD, to be determined commitment letter. This is a pre-approval plus. So you give all of the same information, no more work for you, and then that lender will go to their underwriter and get that turned into an actual commitment. So when we send people out to purchase, they're going out with a TBD, to be determined commitment letter, which says we're going to lend you up to a certain amount, assuming that the property you find is worth what you're paying for it.
You know, I've heard about that in other markets, and what a great strategy. And the only thing, as you mentioned, the only variable is the actual house and the price of the house and how much they're asking for it and how much you can get it for. But it's basically on par with an all-cash offer.
Absolutely. And in this market, again, in some of the more competitive markets, it's very important because many people are bidding against all cash offers. And again, all cash means maybe you can close tomorrow. Maybe you don't care what the appraisal is. But short of that, this is the most valuable piece of paper you can walk into when you're making an offer.
And so, Sol, as I begin the process of looking for a home and I'm talking to lenders and hopefully talking to more than one lender, because it's always good to shop around, what should I be asking them in terms of a fully underwritten loan commitment? What questions should I ask that mortgage person?
You should be asking, what do I need to provide to you in order to get that? And they're going to give you the list of documents. They're going to ask you some questions, and then they're going to go to work. You should also be asking them, once you just start to talk about the kind of loan instrument that you're getting, what are the features of that after you close? Because people often think of the mortgage as something that happens on closing, and yes, they pay it every month. But a lot of them have features later on that can make a difference in your finances and in the way you perceive them. So if rates go down, does your bank or other lender offer you some kind of a program for a small fee to lower that rate without refinancing? In some cases, they do. Does your bank offer you a program where if I put a large sum of money against my principal balance, will you lower the payment in the next month without changing the rate or the program? So those are some of the kinds of things you need to ask in addition to what's the rate, what's it going to cost me, what are the prices, what else do I need to know from you?
Excellent. And I kind of know the answer to my next question. What if you go to that mortgage person and you say, I would like a fully underwritten home loan before I go shopping for a house? And they say, oh, we don't do that. And then you say, well, what if mortgage interest rates drop? Can your mortgage commitment to me drop too? And they say, oh, we don't do that. So what do? Go to someone else and just say, forget it with them?
Well, I think what you do is you go somewhere else and find out if you can get something that serves you better. And again, when you had said before, you should shop around. It's not just shopping for rate, it's shopping for the relationship. It's shopping for the program. It's shopping for long-term support by the lender who may be there for you after you close the loan and you're paying each month, or may not be. And those are some of the questions you need to ask. Are you servicing this loan? If I call you in 6 months and I have a problem, are you the person that's going to be able to help me, or can you get me to somebody in your organization that can help me, or has it gone somewhere else and you're going to give me a new name and number?
And now, Saul, most people who get a mortgage get what's called the 30-year fixed conventional home loan.
Mm-hmm.
It's the most popular mortgage in America by a long shot. But how do I know if that's right for me?
This goes back to figuring out what do your dollars and cents look like. First question is, when you're buying this house, are you buying this house with the intention of it being 3 to 5 years because you want to buy up? Is it with the intention of staying there until your kids are finished with school, if you have kids and you're in a school district? Is it your intention to live there forever? The truth is that before the pandemic, the average note, even if you stayed in the house, stayed in effect for only 5 to 7 years before somebody refinanced or moved or did something with it. It's become a little longer during the pandemic for obvious reasons, because people who were feeling comfortable and in place were not moving so quickly. So it's now about 7 to 10 years. But the truth is, the number of 30-year fixed notes that end in 30 years is infinitesimal. So it's also going to be the most expensive, because if you're asking a lender to sit with a particular rate for the next 30 years, you're asking for them to not make any additional money should that become available. So I always suggest to people, look at the other alternatives, depending on how long you think you're going to be there, and I never guarantee. If you think it's a 3 to 5 year house, you might want to look at a 7-year adjustable rate mortgage. That's going to have a fixed rate for the first 7, can go up and down afterwards, but only in certain pre-described percentages. It's not going to go to infinity, and it's not going to go through the basement. The note's going to, and the mortgage banker will tell you, it can go no higher than this, it can go no lower than that. Also, knowing that you will probably either move or refinance for some reason, whether it's because rates have changed or because you want to take cash equity out of your home, which I guess 30-year fixed is not really the best for you. It's the easiest one to ask for because everybody has one of those, but variety is important.
Well, you make a good point, because the 30-year fixed might be more expensive in the long run, because you are paying interest for 30 years, if, of course, you go all the way to 30 years. But on a monthly basis, it is just about the most affordable mortgage you can get, because your payment's going to be pretty low.
Well, you can get an adjustable with a lower starting rate than the 30-year fixed. The 15-year fixed is going to have a lower rate, but obviously will cost more because you're paying it in half the time. So again, really, it's do the math. That's what I say to everybody through this entire process. This is not emotional. The house is emotional. The getting financing for it and understanding the financing, it's just math. And your mortgage originator and your attorney and your realtor should be encouraging you to look at the math.
And so, Saul, let's think about someone listening to this right now who wants to buy a house in the spring market of 2026. What should that person be doing right now to be successful?
What they should have done 3 months ago, but yes, they'll have to do it now, is get in touch with the lender, have the conversation, and then once you have that conversation and know what you can afford, begin to interview real estate agents. What people don't understand is you can interview lenders, you can interview real estate agents. They're going to work for you. If you were hiring somebody, you'd want to find the best person to do the job that you're offering to them. In this case, you're offering these people a job. When somebody borrows money from my bank, I'm getting paid, not by them, but by the bank. That's my job. The real estate agent is working for you. Their job is to make your life easier and to put you in the best position. So feel comfortable about interviewing. It's okay. I know people have been brought up at some level to think once you find an agent, just work with that person. Talk to a couple of people. Make sure you're comfortable during your initial conversations, and then ask them the questions that will help you understand that they're looking out for you and understand what you're looking for in a neighborhood and a home.
Interesting. And also, you mentioned getting the lender first and then the realtor, but does that really matter? I mean, you could get the realtor first, right?
Well, the problem is if you get the realtor and the realtor says, "What are you looking to buy?" and you don't know what you can spend, I don't know what conversation you're having. So again, I might want a 5-bedroom house with 4 bathrooms, and it might cost $1,300,000, and then I go to the lender and find out that the most I should be buying is a house for 800. So really, you need to know what you can spend. It also, the real estate agent is going to, before they actually take you out, they'll certainly talk to you before, but before they take you out to a house, they're going to want to know if you can afford it. And more of the open houses are requiring people to have some kind of a letter, whether it's a pre-approval or a TBD, before they'll actually send them in, especially in the markets where inventory is low and demand has not diminished.
Hold on, Saul. I had never heard that before. That as you get up to the door of an open house, there's in effect a bouncer there. And he'll say, "Let's see your pre approval letter before you can walk in." Is that really happening?
It is happening in some markets. Again, the highly competitive markets where there are not enough homes available and they are desirable. The agent doesn't want to just have people walk through to see what it looks like. I know in the olden days, as they say, all your neighbors would come to your open house because they had never seen your house because you never invited them in, and now they wanted to know what it looked like. Well, that's not going to work. Again, it is not the majority of open houses because open is suggesting that anybody can come in, but they really do mean open and qualified in a lot of cases, and they're allowed to do that. Remember, that property still belongs to somebody. The agent is representing that somebody, and they have to make sure that they're not wasting their time and your time by letting you wander through something that you can't afford.
Well, that makes perfect sense, but I had just never heard that before, and I appreciate you telling me about it. And so, Saul, another question. Now we've established that, in your view, the first move should be to find out how much house you can afford by talking to a qualified loan officer. Now, what about my personal finances? What should I be doing with my money every day and every week to get as prepared as possible for homeownership?
You should either have rich parents or rich children. Oh, didn't mean. Uh, what, what, what you need to do is know where it goes. And I know this is hard for all of us because, on any given day, gee, I like that. I want to buy it. I'm not talking about a house, but something else, or something costs more today than it did yesterday, which we've all been going through in the last couple of years. So very, very important. Look at your bank accounts. What flows into there? Because when a bank looks at those accounts, if they see a deposit that's larger than what typically comes in for your income if you're paid that way or from other sources, they're going to want to know, where'd that come from? Did somebody give you a gift? If they gave you a gift, there's an easy process by showing what's called a gift letter, which a relative can certainly do when you're going to buy a home. But they also want to make sure that somebody hasn't lent you money that you're going to have to repay, because then all of a sudden your actual debt to income is not what they thought it is. So that's an important part. Then looking at, what do you do normally with your income when it comes in? What can you afford to put aside ahead of time to show reserves? Because most loans are going to include a reserve clause. The reserve is going to be, whether it's 3 months or 6 months worth of pity after closing, so that should you lose your job or should something untoward happen, there's additional money that you have access to that's liquid that you can use to take care of that issue.
Excellent. And the one thing, Saul, we have not mentioned yet is credit. What about my credit score?
Your credit score is important in the following way. Every loan program has a bottom line for what the FICO score or credit score is. The banks typically will pull the reports from all three bureaus. They will throw away the highest and the lowest, use the middle number. Where there are multiple people on the home, they'll look at the lowest middle number from that entire group. So knowing what your number is becomes important because some programs require a minimum of 620, or some other program might require a minimum of 700. After you get through that part, the cost of the rate itself is affected by what your score is.
And Saul, something you said a few minutes ago made me think of so many couples that right now might be looking at each other on the couch with that side-eye look. And
Mhm.
that is, if you're buying a house with another person, you better know their credit score too. Because whatever you might have, say an 820 or so, or a
Mhm.
790, if they have a 690, that's really going to affect your mortgage interest rate.
Absolutely. Remember that when you're doing this with more than one person, the bank is only always going to go to the lowest middle number because they want to protect themselves.
So, Saul, here we are in the spring market of 2026. Now, another big question. We're certainly not in the 3% mortgage interest rate range that we were a few years ago, but at today's rates, does it make sense for someone to refinance in today's market?
Well, it depends on why you're refinancing. If you're refinancing in order to take cash money out to do something else with, it might be. If you're doing it to lower your monthly cost, clearly it's not going to happen. So you need to know why you might refinance. Again, cash out is one way. People also sometimes use home equity lines of credit behind a primary mortgage to take cash out. And so though that's not technically refinancing, it is in the sense that you're taking additional equity from your home.
And Saul, to wrap it up now, how are we looking in the spring market of 26? Is this a good time to get a mortgage? And is it a good time to buy a house, in your opinion?
It depends on where you live and what you want. So the answer is if you know where you want to live and if you know what it's currently costing you to rent, you have to match those up and say, okay, if we live in this other place, if we live in a house, if we're building equity over time by living in the house, is that an advantage to us? If it is, then go ahead and look. There's never, I mean, quite frankly, in terms of a good time, bad time, the rates are always going to go up and down. And so if rates go down precipitously, you're going to have an opportunity to refinance. If they go up precipitously, you're going to be happy that you're not having to worry about that. In terms of the inventory, it's not going to get easier anytime soon because at the moment we have not built enough housing in the last 20 years to accommodate what we need in general. And as long as the cost of owning the house, besides the rate, stays high, people who would otherwise be moving on to smaller homes or elsewhere in the country are doing that less and less so. One of the big issues in terms of inventory is people who are empty nested at one point would typically say, gee, maybe we need a smaller home. Well, when they were thinking about that as downsizing, not only physically, but in terms of cost, with the fact that so many of the homes in the same or nearby areas increase in price, it becomes more like side sizing rather than downsizing. So a lot of the homes that would normally become available didn't. My wife and I sold our house this past January. We had been there for 37 years. In the year that we bought it, there were 6 other houses on that street for sale. In the year we sold it, we were the only one. So in terms of inventory and people doing what you would normally have thought they'd do at a certain time in their life, at the moment, it's not moving in that direction.
I see. And Saul, just to circle back for a moment, the very first thing you and I talked about was being ready, getting your finances ready and knowing what you wanted to buy and finding out how much you could afford. And so if someone were to ask you right now, Saul, I'd like to buy a house. What should I do? Would readiness always be your first answer?
Absolutely. And I will help them get ready. So if they did, I will also ask them questions. They may have actually got themselves in a ready position without knowing it. They may have answers to all the questions which show that they are ready, even if they didn't consciously do it for the purchase of a home. So really having the conversation about income, about assets, about long-term, short-term, all those things preparation for being able to move, what your needs are. A lot of people are thinking about that, but they don't put it into the bucket of home buying until it's time. But many people have done the right work, and that's my job, is to find out how close they are to ready, and if they're not, walk them through it. There are times when I've said, I can get you a certain amount. However, if you did X, Y, and Z, you may become eligible for a larger amount. And maybe that takes 3 months, maybe it takes 9 months, but that's a decision you need to make.
Well, Sol, I really have appreciated talking to you today, and I learned so much from you. And I want to thank you for joining us on the show today and telling everyone about getting a mortgage in 2026. Thank you, Sol.
Thank you, Steve. This has absolutely been a pleasure. I've really enjoyed the conversation.
For me, too. Thank you, Sol. Sol Skolnick, known as Professor Home Loan, a mortgage professional with United Mortgage Corp., a mortgage-only bank. Sol is also the author of the book Home Loans Made Simple. Next time on Real Estate This Week, investing in the spring market. Have you been thinking about buying a rental property? If so, an expert investor will show you the ropes, how to get your first property, and when to buy more. That's next on Real Estate This Week. And until then, I'm Stephen Gasque, and thank you for listening.
A brand new episode of Real Estate This Week with Stephen Gasque drops every Thursday, everywhere. And you're invited to listen, subscribe, and follow us. Just look for Real Estate This Week with Stephen Gasque. The best real estate strategies out there, just for you.